What should you be doing? How do you wait? Do you sit on the sidelines? Do you try and trade it? How do you play that kind of a world? If you're a portfolio manager watching right now and you're trying to get a framework, what does that framework look like?
I mean, for me, the three things you do. Number one is you sell the dollar, because I think the dollar is going to be a multi-year downtrend. It happened in the 1970s after Bretton Woods broke down. For 10 years, the dollar went down. The second thing is you have some kind of short rates trade. So for me, curve steepening makes most sense. That long-end interest rates are going to go up around the world as capital kind of comes back to everyone's sort of home. And the third is, on the equity side, you just go long defense stocks. You know,
and there's more still to come on that. Last...
Absolutely, yeah. There's more to go on that side.
So there's more, but there's more on all of those trades.
More on all of those trades. We're just at the beginning, stage one of multi-stage process.
Give me an order of magnitude.
Well, for example, on say the dollar, say euro dollar, I think we could go to say 140. That's the type of
140.
140, absolutely.
On euro dollar.
On euro dollar, that's
We're
the type of scale.
We're at 114 right now.
Well, 114, yes, 114.
That's why I had to check.
Yes.
This is the scale of moves.
Over what time frame?
This could be within 1 or 2 years. That's the type of scale.
Fast.
That's fast, absolutely, yeah. I mean, if you look at how fast the dollar fell from 2002 to 2004, it was similarly large as this I'm describing. Early 70s is way larger than that. So for me, it's not out of the realms of possibility.
So I'm just sitting here with my jaw slightly open. 140, I can't quite get...
Yeah. So take us to the US economy. I mean, does the underlying state of the US economy matter in that trade? It seems as if interest rate differentials and the state of the US economy may be pushed to the sideline by this broader big picture narrative that you described.
Absolutely, yeah. The normal cyclical dynamics, that's much less important with this type of structural change, because... number one, when you are trying to forecast the U.S. economy, you have to factor in these tariffs and all of these other dynamics, which brings the international order into the equation. Secondly, you have the Fed that's going to try to have to understand how this shift in the international order will affect interest rates. And so normally when interest rates go up, it's good for a currency. But instead, what may be happening is interest rates may be going up to reflect some kind of risk premium that investors are worried about the dollar. So it's kind of more like an EM dynamic. So there's normal drivers won't be as important for the dollar.
And that the ECB might have been hoping for some more of those normal drivers to support exports, I suppose. They wouldn't be maybe happy with 140? I mean...
Absolutely not. No, they won't be happy with 140 at all. I mean, nobody will be happy with a stronger currency. But, of course, there has to be an outlet somewhere for dollar weakness.